We're reshooting this video in 2019. It's my 4-part investing series. It's a reshoot of the 2015 video series where I did it all in one chunk. And for those of you who've watched it, you'll have noted that I was carrying a fair bit of timber back then. So this is new lean me with a new lean presentation with it chunked into 4. First thing I want to look at is where we can invest our capital, and there are 4 main asset classes. Let's look at them. We can invest our money into cash, or rather we can leave it in the bank or the building society, for example. We can invest into fixed income securities. Fixed income, I'm talking about gilts, that's loans to governments. I'm talking about corporate bonds, that's loans to companies. So debt, effectively, we can invest in debt. Come back to that shortly. We can invest in property, and we can invest in stocks and shares, equities. Let's talk about some returns. When I checked my data books this morning, and this is April 2019, the average rate of return from a savings account, be it bank, building society, all crunched together, averaged out over the last 6 decades, was 5.2%. When I look in my data book at fixed income securities, bonds and gilts, the returns from bonds have been approximately 6% over the last 6 years. Okay? When I look at property returns, the returns depend upon which asset you invest in, whether it's residential property, whether it's commercial property, and it also depends whether you do it directly by buying bricks and mortar or whether you do it through a fund. But typically, the returns have been between 10 and 12%. With equity markets, stocks and shares, and I'm talking now about the developed world, this is the UK market, this is the global market. If you look back 6 decades, you will see annualized returns at 10%, 10.2%, something like that. If you look at small cap markets, that's smaller companies, the returns are uplifted to 14%. And we're going to do in one of the videos that's going to be up and coming is going to be looking at those assets in a bit more depth. But for now, let's just get to grips with the returns. I'm going to write at the top there as well, just so you can see. My data book goes back to 1956, all the way up until the back end of 2018. Now, one of the enemies of all of our plans, our investment plans, is inflation. Okay, so RPI, over the same last 60 or so years, inflation's running about 5%. That's through good times, bad times, but that's the number. So effectively, if you're investing in cash or fixed income, you see you're not really going to do much. Okay, 5% is the cost of living, and I always symbolize that by the cost of a first-class stamp. I was born in 1972. In 1972, the cost of a first-class stamp in the UK was just 3p, and in 2019, the cost of a first-class stamp is now 70p. So that just gives us some real-world home truths, really, about where we need to put our money to get us basically through maybe 30 or 40 years in retirement, which is the kind of same window we're looking at here, where we'll see living costs maybe rise 3 or 4 times. A real-life example close to home for me, my youngest daughter, Cecilia, is 10, and she lost another tooth recently, and on the way up to bed, and this is a true story, she came downstairs and said, "Night, Dad." She said, "Just to remind you, I'm expecting a minimum of a £5." And this was for a tooth, and of course, when I was growing up in the 80s, you lost a tooth, you got 10p under your pillow, but there you go, it's a £5 nowadays. So the point of it is we need to really get a grip of this stuff, and we need to understand the different asset classes that we leave our money in. Cash is a non-starter. I spent 14 years with Barclays Bank. If you think about the bank, they're looking after your money. They're paying you 1%, maybe 2% if you're lucky at the moment. Don't forget they're lending that money out. They're lending it out to people for kitchens, cars, weddings. They're typically charging 18, 20, 24%, and they're returning you 1 or 2. So that's not really an option. It's certainly not fair anyway when you look at it that way. Bonds, gilts, treasury stock, corporate bonds. You saw the mess we got into in 2007 where debt was a huge factor. People investing in debt and selling debt on. I don't believe in debt. We'll come back to that in one of the videos up and coming again. So we're really forced into equities, property, and that's where I and Wilcox Invest clients' money. Now, just to finish off, there's two schools of thought on how to make investing in these asset classes work. I'm talking about these two here. One is indexing, and the other is speculating. I'm going to talk about them in my next video. What I can tell you is one works and one certainly doesn't in about 80% of cases. So watch out for that video. It's the next in this series, and I'll speak to you soon. Bye for now.